Hello and a warm welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. Let's check what happened overnight. Well, global markets remaining risk averse as President Trump threatened to impose an additional 50% tariff on China if Beijing does not withdraw its retaliatory tariffs on the United States. And reports that President Trump is considering a 90-day pause in tariffs for all countries except China saw stocks on Wall Street turn positive, although the White House then called that out as fake news. That led to heightened volatility and some whipsaw action there. The Nasdaq finishing in the green amid record trading volumes, while the volatility index reached its highest level since last August. The S&P's biggest drags were Apple and Tesla, while the boost came from Nvidia and Amazon. Meanwhile, corporate leaders have issued warnings on US tariffs, with JP Morgan Chase Chief Executive Jamie Dimon saying they could have lasting negative consequences, while fund manager Bill Ackman said they could lead to an economic nuclear winter. Well, yesterday in China, the Shanghai Composite Index lost 7% in its worst day in 5 years. Shares in Taiwan plummeted close to 10%, the biggest one-day percentage fall on record. Well, US President Trump has said he won't pause tariffs to allow for negotiations with trading partners, but said he would talk to China, Japan and other countries about the duties. China intervened on Monday to support the domestic stocks, with a sovereign wealth fund increasing its holdings in equities and saying it would defend market stability. Meanwhile, the European Commission proposed counter tariffs of 25% on a range of US goods, including soybeans, nuts and sausages. The EU is already dealing with tariffs on cars and metals and faces a 20% tariff on other products due to come into effect on Wednesday. US Trade Representative Jamison Greer says that nearly 50 countries have approached him to discuss new sweeping tariffs imposed by President Trump. Well, US Treasury yields have rebounded on optimism that some countries may negotiate deals with the Trump administration. The yield on the 10-year note rose almost 16 basis points to 4.14%, the 2-year up to 3.73%. And since Trump's tariff announcement, credit spreads, that's the premium companies pay on bonds over treasuries, have widened sharply to 2-year lows. And markets now pricing in a 50% chance the Fed funds rate will be cut by 25 basis points at its next meeting on May 8th. And markets here pricing in a 100% chance the RBA will cut rates by 25 basis points at the next meeting on May 20th. Well, the US dollar index did rise over the day, and the Aussie dollar, though, falling back to 60 US cents. And Bitcoin trading around 79,500 US dollars. Oil prices have fallen to a near 4-year low on concern that the latest tariffs could push economies around the globe into recession and cut demand for energy. Brent futures falling more than 2% to $64 a barrel. Copper, seen as a proxy for the global economy, has continued to fall, down another 3.7%. Iron ore tumbling around 3% to $99 a tonne. And the gold price has fallen below $3,000, having fallen some 2% overnight, with investors turning back to the US dollar as a safe haven. Well, there's so much to get across. Let's go to the States for a reaction. Steve Sozniak is joining us from Interactive Brokers. Steve, welcome back. And I'm just trying to think to our last conversation. So much has changed and investors clearly trying to get their heads around what's going on at the moment. I'm not being rude when I say you've been in markets for a while. How would you characterise what we're seeing at the moment from a historical perspective?
Good morning, Andrew. That was a very charitable way of calling me middle-aged or more, but thank you. Experience is a better way to do it. The way you did it was very nice. This is one of course, the biggest disruptions that I can recall. It's on a par with COVID, the bursting of the internet bubble. The global financial crisis was a bit different. The internet bubble and the global financial crisis were a bit different because they were more prolonged sell-offs. I go back as far as the 1987 crash. None of those were self-inflicted, though, and that's really the difference here. COVID was completely exogenous, although I'd say it's in many ways very similar type of reaction because something occurred out of the blue and we don't really know how to process it yet because we don't really know what it's going to entail or how it's going to affect things fully because things are very fluid. But again, none of these were really self-inflicted. Somebody raised the question about like the 1998 long-term capital management situation, which stemmed from a problem with the Thai baht and I think a Russian ruble devaluation. But those were sort of the butterfly wings flapping somewhere. This was a deliberate policy choice by someone who was elected to the highest office in this country and chose a set of policies that would be incredibly disruptive. And there's still this question of are they are they here to stay? Are they completely inflexible, as some advisors have said, or as Trump himself has alluded to, or are they lining up to negotiate, and that there are 50 countries lining up, and we're going to negotiate these things? Completely up in the air. We're going to start to learn about this from companies starting as early as Friday when earnings season starts again. Yes, the bank earnings are back on Friday, and earnings season starts to really roll out next week. I've had some conversations with various people. Nobody knows what to expect from corporate managements because they're going to get asked about the tariffs, and it's not clear that they have any clarity either. The one thing I think that we could be assured of is that whatever earnings expectations are in there are probably too high if they haven't been adjusted lower. That's definitely what the market's been telling us.
Yet, how on earth do you price in those earnings going forward, given the companies themselves obviously have no clue as to what comes next?
That's why you get the volatility we're getting because the market doesn't know how to do it. We talked about this earlier in the year, and I was a bit skeptical that the 13 to 15% earnings rise for the S&P seemed easily achievable. Yet it was completely priced in and was the source of a lot of bullish arguments. And I sort of said, you know what, I don't know how we get there, but put that in the rearview mirror. Now put that like way in the back because we have no idea what to do. And I don't think the companies do because again, if you're a corporate management, you're pretty good at knowing how to respond to things. Obviously, some things are harder to respond to than others. This is particularly challenging. But what you start to get into is how do you plan if you don't even know that if you don't know what shape form the tariffs are going to take, if they're going to last? Do you onshore your production and then find out, oh, the tariff on whatever you're onshoring is negotiated away? These are also the way they're done is in many ways kind of bizarre. I'm going to give a shout out to the Penguins on Heard and McDonald Island because they've gotten more press than they've ever gotten in their entire lives. But they're being taxed 10%. But in other countries, but in more less ridiculous situations, something like Madagascar has a huge tariff placed on it because we do import vanilla from Madagascar. Now, to the best of my knowledge, there's no domestic vanilla industry in the U.S. for us to protect. Same thing for a lot of countries in South America where we import a lot of tropical fruits. We don't grow tropical fruits. We've got there's maybe a few places you could do it. Hawaii is not big enough to sell, or the South Florida is not big enough to sell tropical fruits to the rest of the entire U.S. So it's not at all even strategic because certain industries are just everything's being swept up in this, whether or not there's any strategic benefit from onshoring that production or from putting a tariff on it.
Well, now, of course, focus very much on what comes next in terms of China, with Donald Trump threatening to throw another 50% on Chinese exports. And then, of course, on top of that, you look at the power, I guess, that China holds in this negotiation at the moment, Steve, which you've mentioned here, the potential there that it could cut back or even boycott purchases of US treasuries. Then, of course, it can also further manipulate its currency as well.
Yeah, they have, I understand the rationale about sort of some targeted tariffs back and forth. Trump did it in his first administration. Quite frankly, Biden kept those tariffs in because there was a logic to them. But China certainly has its weapons that they can deploy. Here's the basic economic fact: if you have a trade surplus in goods and services with the world, I'm not going to pick on one country, with the world. Well, that needs to be offset somehow. And in this case, the rest of the world has been pretty eager to buy our assets, whether they're government debt or whether they're equities. Obviously, nobody's quite as keen to buy our equities lately, but nobody's quite keen to buy anybody's equities right now. But basically, that money has flown in, and that's been a source. That's been a source of funding for how we pay for these deficits. It doesn't go on indefinitely, but that is basically what goes on. But so if you want to think about it in those terms, one of our biggest exports is our government debt. And so if China decides they're not going to buy that debt, well, that raises interest rates throughout our economy because somebody's got to buy it at some point. And that is, I think, why you saw bond yields tick so much higher today. In pretty much after the threat of even further tariff retaliation back and forth on a tit for tat basis. And one of the things that I like to remind people is, if you can't price low risk assets such as 2-year treasuries, which had, I think, between the pre-market and the regular session, I think a 25 basis point range. If you can't price low risk assets, what hope do you have to price higher risk assets like equities? So until all this gets sorted out, the volatility sort of has no choice but to continue.
Well, and to that point then, Steve, we're almost out of time, but if you are an equity investor, how can you position yourself at this point, given what's happened?
Interestingly, I think the risk is more to the shorts, more if you're short than if you're long, because you had the little graphic below. Bear markets are short, sharp, and ferocious. We saw the way we rallied today on the slightest bit of good news. We basically popped 7-8% in the S&P 500 from lows to highs. The highs didn't last because the story wasn't true, but it shows you how desperate the market is to grasp onto any decent piece of tariff news. And so you get to a point in these kind of markets where you just really want to be nimble one way or the other. There are certainly bargains to be had because you don't get a dislocation like this without some good stuff being thrown out with the bad. It's not that easy to find right now because everything is moving so fast. But I think this is very much a time to be nimble because you could get whipsawed very easily.
Steve, always so valuable to get your insights from Interactive Brokers. Thanks so much for joining us.
My pleasure, Andrew. See you soon.
So let's turn now to what's ahead for us here locally. And SPI futures indicating we're going to get a bit of a bounce at the open as we attempt to recover some of those steep losses we've seen over the past couple of sessions. They're up 0.75%. We're going to get right across it when we get going in just a couple of minutes' time.